All right, guys, let's revisit the VIX here, as I think it's an important time of the calendar year to revisit this. And we covered this last week. We talked about the case of buying insurance when it is cheap, and we subsequently got that pop there. Now, if we take a look here at VIX positioning, so basically, when you think about institutional investors, they're not looking at 5-minute and 1 hour candlestick patterns. So you got to think about them building positions often take days or even weeks as capital is deployed in large blocks across multiple assets in multiple trading sessions. And when risks begin to surface, these investors will start hedging their existing portfolios rather than selling the assets. And one common way they do that is by purchasing volatility protection, often through instruments linked to the VIX. So VVIX, that's the one in red. That measures the expected volatility of VIX options. Essentially, it's the market's uncertainty about future volatility itself. So when VVIX front runs the VIX, it suggests a few things. Option markets are pricing elevated tail risk. It hasn't materialized in spot volatility yet. 2, heightened uncertainty about volatility regimes. Dealers and sophisticated traders are paying up for protection. And then 3rd is a potential regime shift ahead. So periods of calm, i.e. low VIX, with high VVIX often precede volatility explosions. So if we come back to the chart that we looked at last week, we mentioned observing volatility hedging flow through options markets. And of course, we saw the VIX spike this week as markets retreated from the all-time highs. So let's end with this note here, looking back at the seasonal expectations. Remember, seasonality is just a guide showing us what history has done in the past. You can see that we experience a little bit of mixed performance here, a little bit of strength right out of the gate into the new year, followed by mixed results, and then followed by a mean reversion here into the March timeframe. This is the S&P 500. Here is going to be the inverse picture through the lens of the VIX. So as you would expect, equity markets pulling back, VIX rising. Considering where price is today relative to where we've been in the past, this may be a good indication to pick up cheap insurance.